$38 trillion. That's America's national debt right now, today, not next year, not projected. Actual debt as of December 2025. Here's what should terrify you. The former Treasury Secretary, the former Fed chair, the woman who ran America's financial system for 4 years, just publicly admitted we're entering fiscal dominance. Why is nobody talking about it? January 5, 2026. Janet Yellen stood before the American Economic Association and said 8 words. The preconditions for fiscal dominance are clearly strengthening. So what is fiscal dominance? It means the debt has become so large that it controls the Federal Reserve instead of the other way around. The Fed can't fight inflation anymore because raising interest rates would make the $38 trillion debt unpayable. They're trapped. The debt is in control. And Yellen just admitted it's happening right now. Here's the number that proves she's right. U.S. national debt, $38.5 trillion. Annual interest payments, $1.07 trillion. Let me put that in perspective. In 2020, the government spent $345 billion on interest. In 2026, it's spending $1.07 trillion. That's nearly triple in just 6 years. Are you tracking this? The interest payment tripled while the debt only grew 50%. Why? Because interest rates went from 0% to 5%. And here's what makes this catastrophic. Every 1% increase in interest rates adds $385 billion in annual costs. The Fed wanted to raise rates to 6 to 7% to fight inflation. They couldn't. Because at $38 trillion in debt, that would add $7 to $70 billion in interest costs overnight. So they're stuck. Can't raise rates without bankrupting the government. Can't lower rates without letting inflation run. That is fiscal dominance. The debt controls monetary policy, not might control. Controls. Right now. Today. And once you cross this threshold with $38 trillion in debt and $1 trillion in interest, there's no mathematical path back. You can't grow fast enough. Would need 5 to 6% GDP growth for 20 years. Not happening. You can't cut spending enough. Would need to eliminate 40–50% of the federal budget. Politically impossible. You can't tax enough. Doubling income taxes would crash the economy, reducing revenue. The math doesn't work. The pattern has already won. The only option left is the one Yellen's warning about. Monetization. The Fed prints money to buy Treasury bonds. The government uses that money to pay bills, then issues more bonds. Then the Fed prints more money. That's not a market. That's a printing press funding a government. And once it starts, it never stops. This isn't a forecast. This is mathematics. And Yellen just confirmed we're entering this phase. Now here's what makes this urgent in 2026. When China dumped $630 billion in treasuries from 2013 to 2024, someone had to buy them or the market would collapse. Who absorbed it? The United Kingdom, now holding $750 billion. Belgium, holding $370 billion through custodial accounts. Japan, holding over $1 trillion. These aren't private investors buying for profit. These are political buyers absorbing to prevent system failure. But political buyers have limits, and they're hitting them right now. Look at this signal. The 10-year Treasury yield is at 4.29% in January 2026. Despite the Fed cutting rates 3 times in 2024-2025, Treasury yields barely moved. Why? Bond investors are demanding higher returns because they're worried America might not pay them back. The bond vigilantes are returning. And when bond vigilantes return, they push yields higher. When yields spike with $38 trillion in debt, every 1% increase costs an extra $385 billion per year. The system doesn't bend. It breaks. Right now, 3 countries are preventing that break. But they can't do it much longer. The UK is levering their balance sheets to absorb. They're borrowing to buy U.S. debt. That's not sustainable. Belgium is warehousing for clients who don't want to be identified. When those clients liquidate, Belgium's holdings vanish. Japan is caught between defending the yen and absorbing treasuries. They can't do both forever. These are the hidden buyers, and they're running out of capacity. When they stop, only one buyer remains, the Federal Reserve. Now here's what Yellen didn't say in that speech, but the data reveals. She didn't say when this breaks, but the timeline is visible. Yellen used a powerful analogy to explain fiscal dominance. She said, imagine the economy as a car. The Treasury controls spending. That's the gas pedal. The Fed controls inflation by raising or lowering rates. That's the brake. Now imagine that car is towing a $38 trillion trailer. The trailer is so heavy that if the Fed hits the brakes, by raising rates to fight inflation, the brake pads explode. Because every time rates go up, interest costs go up. At $38 trillion, a 1% rate increase adds $385 billion in annual payments. So what happens? The Fed is forced to keep its foot off the brake, even when the car is speeding toward a cliff. Because hitting the brakes causes immediate fiscal bankruptcy. That is the trap. The debt controls the Fed. The Fed can't control inflation. Currency debasement becomes the only option. Former Fed economist Eric Leeper, who wrote the textbook on fiscal dominance, put it bluntly. The Fed only has the tools if we're not in a fiscal dominant world. And increasingly, we are. This isn't opinion. This is the academic consensus among monetary economists. Share this with someone who thinks the Fed controls the economy. They need to see what's actually happening. Interest payments are now approaching 20% of federal revenue. When interest crosses 15% of revenue, monetary policy becomes subordinate to debt service. You can't set rates based on the economy. You set them based on what the government can afford to pay. We crossed 15% in 2024. We're at 19.8% now. And here's why this accelerates. The debt grows at 6 to 7% annually. The economy grows at 2 to 3%. Interest rates are 4 to 5%. The debt compounds faster than the economy grows. It's a doom loop with no exit. Drop a comment if you understand why this can't be stopped. I'm reading everyone. Here's what happens when the hidden buyers exhaust and the Fed becomes the buyer. It's called yield curve control. The Fed starts buying Treasury bonds directly to prevent yields from spiking. Japan's been doing this for over a decade. Their debt to GDP ratio is 260%. They can't raise rates without making their debt unpayable. They're trapped in permanent near-zero rates. And their currency lost 40% of its value against the dollar since 2020. That's America's future. Here's the mechanism. Step 1. Fed prints dollars. Step 2. Fed buys Treasury bonds with those dollars. Step 3. Government issues more bonds to fund deficits. Step 4. Fed prints more dollars to buy more bonds. That's not a market. That's a printing press funding a government. And once monetization begins, it never stops. Not rarely. Never. Japan proves it. Europe proves it. History proves it. Because if the Fed stops buying, yields spike. If yields spike, debt costs explode. If costs explode, the government faces two choices: cut 40–50% of spending or default. Neither will happen. So the Fed prints, and keeps printing, permanently. And the outcome is always the same: currency debasement, not overnight hyperinflation. That's not how reserve currencies fail. They fail through slow, steady erosion of purchasing power. A dollar that buys less every year. Savings that evaporate in real terms. Wages that never catch up. The pattern is mathematical. The pattern is inevitable. The pattern is executing right now. Most people are watching for hyperinflation. Weimar Germany. Zimbabwe. They're looking in the wrong place. Reserve currency transitions don't happen through collapse. They happen through replacement. Look at Britain. 1914. World War I begins. Britain is the global superpower. The pound is the world's reserve currency. 1918. War ends. Britain is victorious but financially destroyed. They borrowed billions from America. 1931. Forced off gold standard. The pound devalues but remains dominant. 1944. Bretton Woods. The dollar officially becomes the global reserve. Britain's century of dominance ends. That's 30 years, from peak to displacement. The pound didn't collapse. It was slowly replaced. And by the time it was obvious, the wealth transfer was complete. That's the pattern executing now. Dollar's share of global reserves, 71% in 2000, 58% in 2024. Foreign holdings of U.S. Treasuries, 40% in 2010, 15% in 2025. Each BRICS payment system, each yuan oil sale, each bilateral trade agreement removes structural demand for dollars. Each time the Fed prints to buy treasuries, purchasing power erodes. The system doesn't collapse. It's replaced. And we're watching it happen in real time. If you're not connecting these dots yet, here's the simple version. The dollar is losing reserve status. Not in theory. In practice. Right now. The British pound took 30 years, but the acceleration happened in the final 5 years. The dollar's been declining for 24 years. We're entering the acceleration phase. Question: what percentage does the dollar need to fall to before it loses reserve status? 50%? 40%? 30%? Drop your prediction in the comments. Now pay attention because these 3 data points will tell you exactly when this activates. There are 3 specific events in the next 90 days that will confirm everything I just showed you. March bond auctions. The Treasury auctions hundreds of billions in bonds to refinance maturing debt. Watch the bid-to-cover ratio. That's bids received versus bonds sold. Historical average, 2.3 to 1. Healthy demand. If it falls below 2.0, demand weakening. If it falls below 1.5, red alert. Treasury struggling to find buyers. That's when the Fed must intervene. April 29 to 30. Fed meeting. Watch what they say about their balance sheet. If they mention flexibility or adjusting quantitative tightening pace, that's code for, we're preparing to buy again. If they explicitly pause QT, Stage 6 activating in real time. May refunding announcement. Treasury announces debt issuance for June-August. If they announce over $600 billion for 1 quarter, spending out of control. If foreign buyers don't absorb it, Fed becomes buyer of last resort. These aren't possibilities. These are certainties. The auctions will happen. The Fed will speak. The data will print. The only variable is whether you're positioned before the confirmation. I'm tracking all 3 in real time. If you want the analysis when these signals hit, not when Bloomberg reports them 3 days later, hit subscribe and turn on notifications. Because the smart money positions before the data confirms what they already know. Now let me show you how we got here because the pattern is precise. Stage 1. Adversaries exit. China sold $630 billion from 2013-2024. That forced someone to absorb it. Hidden buyers stepped in. Stage 2. Partners. Hedge India liquidated $50 billion and moved 274 tons of gold home. They saw the trap forming and insulated. Stage 3. Substitute strain. UK, Belgium, Japan absorbed the selling. But their capacity is finite. They're hitting limits now. Stage 4. Resource grabs Venezuela operation. $17.3 trillion in oil seized. Desperate attempt to back the system with hard assets. Stage 5. Alternative systems $291 billion in trade flows moved off dollar rails. BRICS payment systems. Yuan oil sales. Structural demand disappearing. Stage 6. Fed becomes buyer. This is where we are now. When hidden buyers break, the Fed monetizes. Permanent printing begins. Each stage enables the next. Each was predictable. Each executed on schedule. Rome followed this pattern when the denarius failed. The Dutch when the guilder collapsed. Britain when the pound lost reserve status. America is following it now. Not because of politics. Because of mathematics. The pattern doesn't care about beliefs. It doesn't wait for consensus. It just executes. Drop a comment if you've been tracking this series from the beginning. I want to see who's been paying attention. You're probably asking, if this is so obvious, why isn't everyone discussing it? 3 reasons. First, the people who see it are positioning, not broadcasting. When billionaires like Bill Gates liquidate 2/3 of their Microsoft holdings, when Warren Buffett sits on $325 billion in cash, when 142,000 millionaires relocate internationally in 1 year, they're not announcing why. They're quietly moving before the crowd figures it out. Second, the people broadcasting don't understand the pattern. CNBC talks about soft landings and transitory inflation. They're looking at quarterly data. They miss the multi-decade pattern playing out. By the time mainstream media reports fiscal dominance, the transition is already complete. Third, admitting the problem requires admitting there's no solution. No politician will say, we can't fix this without crisis. No Fed official will say we're trapped and monetization is inevitable. They'll frame it as temporary emergency measures, as prudent policy adjustments. But Yellen just admitted it. She used the exact term, fiscal dominance. She said the preconditions are strengthening. This isn't my opinion. This is the former Fed chair's admission. The only question is whether you believe her or not. Some will say this is fear-mongering, that I'm exaggerating. I'm citing the former Fed chair. I'm quoting her exact words. I'm showing you the Treasury data, the bond yields, the foreign holdings, the interest costs. The data doesn't lie. The pattern doesn't care about comfort. It executes whether you're ready or not. So what does this mean for your money? If you're 100% in dollar-denominated assets, stocks, bonds, savings accounts, you're exposed to currency debasement risk. Not next year, not 5 years from now. It's happening right now. The Fed is already choosing between raising rates and breaking the debt, keeping rates low and letting inflation erode purchasing power. They're choosing erosion. Every single time. That's why inflation came back after they claimed victory. That's why yields aren't falling despite rate cuts. That's why the hidden buyers are straining. The system is choosing slow currency death over fast debt death. And that means every dollar you hold loses value in real terms. Every year. Compounding. Here's the brutal math. At 3 to 4% real inflation, your purchasing power halves every 18 to 20 years. At 5 to 6% real inflation, it halves every 12-14 years. At current trajectory, inflation settles at 4 to 5% for the next decade. Maybe 2. That's your retirement, your savings, your dollar-denominated assets, losing half their value, not from a crash. From steady erosion you barely notice until it's too late. This is how reserve currencies die. Slowly, then suddenly. Question for you. Are you positioned for this? Or are you still 100% in dollars? Be honest in the comments. The community here has incredible insights on how people are protecting themselves. Let me show you the exact parallel because Britain lived through this 80 years ago. 1918. Britain wins WWI but borrows heavily from America. 1920s. They try to maintain the pound's value, high interest rates, austerity, defending the currency. 1931. Forced off gold. Pound devalues 25%, but they keep insisting it's temporary. 1940s. W2 destroys what's left. More borrowing, more debt, more promises. 1944. Bretton Woods. The dollar officially replaces the pound as global reserve. But here's what nobody tells you. The wealth transfer happened silently between 1920 and 1940. British citizens holding pounds and pound assets watched their purchasing power evaporate. They didn't notice until it was too late. American citizens holding dollars are watching the same thing happen now. China exited 2013-2024. India exited 2022-2024. Partners building alternatives 2020-2026. The wealth transfer is happening, not in headlines, in flows. And by the time it's obvious to everyone, when the dollar officially loses reserve status, positioning is impossible. The British didn't believe it would happen to them. It happened. Americans don't believe it will happen now. It's happening. The pattern is absolute. The pattern is inevitable. The pattern is mathematical. Here's what I want you to do right now. 3 things. First, subscribe if you haven't already. This series continues. The March auctions, the April Fed meeting, the May refunding announcement. I'm tracking all of it in real time. You want to see the analysis before Bloomberg reports it, before CNBC talks about it, before everyone else figures it out. Hit subscribe. Turn on notifications. Second, share this with one person. Someone who's 100% in dollar assets. Someone who thinks the Fed has everything under control. Someone who needs to see what's actually happening. The pattern doesn't require mass understanding, but the people you care about deserve the warning. Third, comment your biggest takeaway. I read every comment. The discussions in this community are some of the best financial education you'll get anywhere. Tell me, what percentage you think the dollar needs to fall before it loses reserve status, whether you're positioned for debasement or still exposed? What you think breaks first, UK, Japan, or Belgium? These aren't rhetorical questions. I'm genuinely asking. I learn from this community. Because while the pattern is absolute, the timeline has variables, and collective intelligence spots inflection points faster than any individual. The pattern is accelerating. Stage 6 is activating. The Fed is becoming the buyer of last resort, and when the Fed becomes the buyer, the dollar becomes the payment. That's the $38 trillion trap. And we're already inside it. The British didn't understand in the 1880s that their capital was building America while their empire hollowed out. Americans don't understand now that the Treasury market is no longer a market. It's a coordination mechanism approaching failure. But the pattern doesn't wait for understanding. It doesn't wait for consensus. It doesn't wait for permission. It just executes. Like clockwork. Like mathematics. Like gravity. This isn't fear-mongering. This is pattern recognition. The same pattern that destroyed Rome's denarius. The same pattern that collapsed the Dutch guilder. The same pattern that ended the British pound's dominance. Without exception. Without mercy. Without deviation. Rome. The Dutch. Britain. America. The pattern is absolute. The pattern is inevitable. The pattern is mathematical. The pattern is executing right now. Flows don't lie. Welcome to Geopolitics of Money.